Good afternoon, everyone, and welcome to this webinar on Latin American equities. We'll shortly be hearing from Sam Vecht, manager of BlackRock Latin American Investment Trust. There are lots of interesting structural drivers behind equities in the region at the moment, and no doubt we'll talk about those, but it's worth noting that the shares of the trust themselves are on a 15% discount at the moment, so this could be a very interesting time to be considering an investment. I know Sam wants to keep this as interactive as possible. He will be giving a presentation, but please do fire in your questions. We would like to answer as many of those as possible. There should be a box on the right of your screen. So please put your questions to Sam and we'll try and get the conversation going. So Sam, with that, I will hand over to you.
Thank you, everyone. Thank you very much for joining us on this fabulous afternoon. It's sunny here in London. It's even sunnier in Latin America, although it's slightly earlier in the day. Thank you to our friends from Kepler for hosting us today. And as was said, please send questions in. We will make this as interactive as you allow it to be. So without further ado, I'm going to do a very brief presentation on the trust. But as I said, what's key for us is to address the issues and questions that you have regarding Latin America in general and our trust specifically. So if we just kick off, this is an investment trust looking at every single country in Latin America that has listed stocks, whether they are listed in Latin America or listed elsewhere. My co-manager is Chris Brinkman, who I've worked with for his entire career. For 9 years, he has sat within a meter of me. I feel a little sorry for him, but so be it. And this is an investment trust, one of the very few investment trusts looking at Latin America, as is always the case. As markets are in bear markets, the number of people interested in them falls. And obviously, that's probably when people should be getting excited about Latin America for the reasons I'm going to highlight shortly. So a little bit about how Latin America works. Remember, we're not going to tell you wonderful stories about the beauty of Latin America. It's an extremely complex and diverse part of the globe. The markets are extremely volatile, enormous amounts of dispersion. 70%, 80% of stocks in many years move 40% or more, but it is a very opportunity-rich area. It is, as we say here, complex, volatile, and diverse, but that is the nature of emerging markets. That is exactly the nature of Latin America, and it's also the reason why many people get very scared about this part of the world. Of course, investors should only consider investing in Latin America in general if they have a medium or long-term view. Short-term investing will not do well in any of the countries in Latin America. The way we think about Latin America is we have a research engine, a very large team spending a lot of time on the ground in Latin America. Personally, in the last year, I have been to Brazil and Mexico and Argentina and all the normal countries in Latin America, but I've also been to Ecuador and Panama and Guyana, the world's fastest growing country, interestingly enough, a country that doesn't get very much attention, and Costa Rica and all sorts of other places looking for interesting opportunities. For us, Latin America is not just Brazil and Mexico, it is the entire continent of South America and much of the Caribbean, Mexico, and Central America that we're looking for opportunities in. If we just go forward, at the moment, lots of opportunities in Brazil and Mexico. Perhaps the more interesting slide is this one over here, where you see a very diverse portfolio across really a range of sectors. One of the beauties of Latin America, regardless of which stocks are listed in which country, is that sectorally there's really a big opportunity. And if you look at how we are currently positioned, and this is where I'm starting, you'll see we have fairly little exposure to the utility sector, which actually is fairly low beta and not very exciting to us. Where we see the really big opportunities today are in consumer discretionary sector, because the economies are doing a little better than many people think. In industrials, some of the companies exporting to the world, exporting Latin American know-how to the world. And if you look on the left of this slide, you can see while financials are big at 28%, they're not particularly dominant, and we have pretty good exposure to most of the sectors in the market.
Sam, we have a question on Mercado Libre.
Yeah.
Do you have any views on it as a potential investment? Have you held it?
I rather not talk on individual stocks, but you'll see on this slide that it does not feature in our top 10. And what I'd say is the opportunities in e-commerce and the extension of credit across Latin America are substantial. That said, I am typically fairly cautious about companies anywhere in the world that trade at very high multiples. And, whether that's true for Mercado Libre, true for other companies. Again, I don't want to speak about Mercado Libre specifically. It may very well be a great company doing great things, as may other companies, but with high multiples. But the key question for us is it, and indeed any other stock, is what is already priced by the market. My experience across Latin America, across emerging markets, tells me that stocks with very many buy ratings and very few hold and sell ratings are much more likely to fall sharply when there's an incremental piece of bad news. And there is always bad news about all stocks at some point in the cycle. So without wanting to focus on one specific company, I would make a general point about companies that don't appear in our top 10, and the company that was specifically asked about doesn't appear in our top 10. I'd make a general comment about companies trading with high multiples is the risk of investing in such companies in emerging markets in general is far higher than it is when one invests in high multiple stocks with their predominant focus in developed markets. People have a natural crowding towards what looks to be growing fast and what may actually be a great company, but great companies and great stocks are not the same. And it's really important to highlight that. Our focus is in making money for our clients in an honest, legal, ethical, and moral way. Our focus is not in producing beautiful PowerPoint slides about how wonderful the companies we are investing in. And the reason I say this is that typically in emerging markets in Latin America, and it's one of the reasons why many people have done poorly investing in emerging markets and in Latin America over time. People like to buy stories, people like to buy growth, people like to buy what appears to be good companies. Good companies and good stocks are not always the same, and the difference is often the multiple that one pays for these companies. High multiple stocks in emerging markets in general are a really bad idea, and that's specifically true in Latin America.
We have a couple of questions on the geography. You have more than 90% invested in Brazil and Mexico. Is that usually the case? And then
okay, let me hold on. Do one question at a time. My brain unfortunately makes me forget anything that isn't Spurs or more than one question. It happens to be the case that where we see a vast majority of the opportunities in Latin America happens to be in Brazil, which, as we'll see in a slide perhaps a bit later, is pretty much the cheapest it's ever been. The economy is growing faster, and we think rates are going to come down. And we also see a lot of opportunity in Mexico. I would love to have much more exposure elsewhere, but the unfortunate aspect is that the portfolio has to add up to 100%, and we can take a little leverage, but broadly we can only be sort of 100, 110, 115% exposed. So we just see many better opportunities within Latin America, in Brazil and Mexico today. A few months ago, we definitely had more exposure to Panama. We had more exposure to Ecuador. We definitely anticipate to have some exposure to Guyana in the future. It just so happens that where the liquid opportunities are today in Latin America is in Brazil and Mexico. I would expect at most points us to have a large position in Brazil and in Mexico just because there's so many opportunities there. But will it be 90% going forward? I would expect it to be lower than that. Would it be 40 or 50%? I'd expect it to be higher than that. Sorry, question. Thank you. And the second question, sir?
And can you invest in companies that aren't listed in LATAM but heavily exposed to the region?
Yes. Yes. And so companies that, often companies that say, if you're a company based in Panama or based in Ecuador, there's not a very big liquid stock market. So you may choose to be listed in the United States. And absolutely, we can, will, and do invest in companies that are listed in the United States, or indeed in the UK or Europe, but have the dominant portion of their business in Latin America. So often we'll find industrial companies, financials listed in the US. We'll often find mining companies, for example, with lots of operations in Latin America, listed in Canada, listed in the UK, even occasionally listed in Australia. And we will and do invest in such companies. Thank you for that question. It's a very relevant point. So
on the miners, is the
Yeah.
China stimulus that we've heard so much about in the last month or so, is that beneficial for the mining companies?
It is. Obviously not for gold miners very much, but definitely for companies that we would have in Latin America that may be exposed to iron ore, or companies producing copper, companies producing the commodities that China needs. That said, I would not be buying Latin America based purely on Chinese stimulus. I think there are lots of reasons to be positive about the Chinese stock market today, and indeed possibly a little less bearish than some people are about the Chinese economy, but I wouldn't be buying Latin America for that exposure. It's helpful, but that wouldn't be the reason to do it.
And Neil asks why I keep interrupting the presenter. But I can assure you, Neil, that Sam has specifically requested that I do so.
So Neil, whoever Neil is, I've specifically asked to have questions. I like interactive sessions rather than a monologue. My wife tells me that listening to me is one of those boring things in life, and I probably agree with her on that. And I would suggest that all the people who've dialed into this would also feel it's boring listening to me. And the questions are far more interesting than my monologue. So these are the top 10 positions. As I mentioned earlier, I'd rather not focus on individual stocks. Questions like, what's your top pick? I never feel particularly helpful, because what's important for us is to actually have a diversified portfolio across different sectors, across different countries. But for what it's worth, and we think in terms of a portfolio rather than individual names, but for what it's worth, this is our top 10. In terms of our market outlook, and keep the questions coming in about 1 minute time. As a reminder, where real rates are in Latin America. So what's a real rate? That is the official interest rate, or the most important interest rate in the country. Often countries have several, but we'll just take the policy rate and then take away the level of inflation. So if we think about the US, the UK, other countries in the G7, real rates are 1-2%. In Latin America, they are much higher at 6-7%. And we think over the course of 2025, that gap is going to be reduced. We think rates are going to come down in Brazil. Rates are going to come down in Mexico, and that's going to provide a very supportive backdrop to the stock market. So the carry trade, as it's referred to, strikes us as one very attractive reason to be long Latin America today. If we go down another slide, what's interesting about Latin America is that they've sort of been a bit ahead of the curve in terms of raising interest rates. And I think if you just look at Brazil and Mexico, you can sort of see sort of a slightly longer time period than we had on the previous slide, where real rates have been. You can see real rates have been negative at times in Latin America. They've definitely been a lot lower than they are today. If you look at real rates in Mexico, once again, the policy rate, take away inflation, it's pretty much never been this high in Mexico, well, not for the last, 15 years. Similarly in Chile, similarly in Colombia, and actually, even by Brazilian standards, real rates are pretty high, which gives us the conviction that over the next 12, 24 months, real rates are going to come down, and that to be very supportive for the market, and especially for the valuation that people are paying for stocks. And we'll come back to that in a second. One of the things that's been a challenge for Latin America has been government prudence. It's interesting to see that while Brazil's had some issues in that regard, it definitely looks better than the United States, as we can see in the top left slide. If we look at the bottom left slide, we can see that the trade surplus in Brazil has rarely been this significant. Exports are absolutely booming, often commodities, and that's hard and soft commodities, corn, soya, significant in that. Obviously, iron ore we referred to earlier, but also industrial exports. This level of trade surplus that we're showing on the bottom left of this slide, I think is really notable and very different to where we were perhaps a decade ago. Inflation, very much in check. It's interesting, I think in the last month, Indian inflation has actually gone above Brazilian inflation. So when we look at inflation levels in Brazil, obviously come down a long way from where they were a couple of years ago, and broadly in line with where the United States is. And then if we look at where valuations are, it's really quite interesting. 7.8 times PE for Brazil, and we'll have a little look at how cheap that is compared to history in a second.
Could you say something about your view on the higher risk markets in the region, such as Argentina or Venezuela? Are there any interesting companies there that offset the macro risk? Is Venezuela a market you can invest in?
Currently not, given sanctions. If I go back to early in my so-called career, we definitely had investments in Venezuela. However, currently the UK Foreign and Commonwealth Office advises against all but essential travel to Venezuela. In terms of Argentina, it's a country we know well and been to many times. It's definitely a higher risk. We think after the World War I, Argentina was the third richest country in the world. It's very far from that today. So the current government has made some good strides to trying to change people's perception of Argentina and actually how the country is run. That said, we're not convinced yet that all the measures that need to be taken have been taken. We think there's a risk to the currency still today. We're much more comfortable investing in countries where we think the currency is fairly valued, and we're a little concerned about the current level of the currency there. So if the currency were to devalue, again, from where it currently is, I think we'd be much more comfortable. So these are markets we spend a lot of time going to, a lot of time visiting companies in. We want to be ready to invest. We do have some small holdings historically in Argentina, but we could have a lot more. And going back to the question that someone asked earlier, we'd be very happy to have a much bigger weight in Argentina if the currency was more sensibly priced. A word on Mexico. I think it's really quite interesting. If you look at the top left chart here, Mexico recently, in the last 18-24 months, has replaced China as the biggest single exporter to the United States. So in terms of a share of US imports, Mexico has overtaken China. China keeps falling as a function of some of the trade tensions, some of the political tensions, and definitely many Americans, despite what any politician may be saying, and obviously there's an election coming up in the US, I think most politicians, regardless of which party they are in the United States, are much more comfortable trading with Mexico than they are with China. And that's what explains why, Chinese exports, or Chinese share in US imports have pretty much, down 40, 50% over the last 8 years, while the share of Mexico keeps rising. We look at Mexico, fixed asset investment is really booming top right of this slide. And it's interesting if you think about it, over the last 4 or 5 years, the Mexican market has actually outperformed the S&P, or roughly in line with the S&P. The S&P has done really well for the last 4 years, but Mexico has pretty much matched the S&P, which I think surprises some people. So until fairly recently, we were pretty cautious on Mexico on a relative basis because it's done so well, with lots of people being much more concerned, in our view, wrongly, about the new Mexican political administration. We've had an opportunity to add to our Mexican positions.
We had a question whether you think it's likely the US could impose tariffs on imports from LATAM countries.
I think it's likely that there will be increasing amount of tariffs globally. I think we're seeing sort of protectionism in various forms increase, and I think there's every possibility that there will be some tariffs on some goods from Latin America. I think some of the more extreme scare stories that one can read in the economic media are probably wide of the mark. So I would expect there to be some tariffs, but if you make things fairly cheaply and you are sort of in good political relationship with the US, I think the tariffs will be lower, and the average US consumer will want to buy goods at a cheap price. And I think Latin America, especially northern Mexico, for people who have been there, has the ability to produce a very wide range of goods at a really competitive price, and fairly small tariffs are not going to compete away that advantage.
What is your view on the new Mexican administration? Continuation of AMLO, better or worse?
I think it's going to be better. I was very fortunate, although it was deliberate, to be in Mexico the day after the Mexican elections. There are Mexican elections every 6 years, so you kind of know when they're going to happen. And I chose to be in Mexico City the next few days. And the reason why I did that is we sensed there may be an opportunity with people getting very worried about a new government. And then sure enough, the market sold off and we added to our Mexican positions then. I think the current government is going to be more focused on social issues. Education, healthcare, housing are going to be more important. I think Claudia Sheinbaum is going to do more international outreach. I think we're going to see the current president be much more active on the international sphere. And I think there is going to be perhaps a slightly different relationship between the government and some of the state-owned enterprises like Pemex. I think we're going to see probably a less hostile interaction with the private sector. It is notable to me that in the 3 months since she won the election, now 4 months since she won the election, she has met a very large number of US and global CEOs. It's not just the BlackRock CEO she's met, but she has met, by my guess, 20, 30 different S&P 500 CEOs over that period of time, possibly even more. There is a list out there. And that, to me, isn't the action of someone who is going to ignore the private sector. The fact that she has taken so much time out of a busy schedule to meet the CEOs of financial companies, industrial companies, manufacturing companies, consumer companies. At one stage, she was meeting almost a CEO a day, a US CEO a day, tells me that there's going to be a much bigger focus on attracting foreign investment, attracting the right sort of investment into the country, and I think that's a positive.
Turning back to Brazil, we had a question about the valuations that you showed earlier and how low they are Does this reflect a confidence deficit or is it something else?
That's a really good question. I've just flicked over one slide that we hadn't seen before. I know this is a messy slide, but I think it's quite useful to give some context to the question just asked. So I didn't catch the name of the person asking the question, but to the person, sorry, I perhaps forgot it.
JW was the initials.
Pardon?
JW.
JW, right. JW, thank you for this question. And I think this is an important bit of context. What we see on this slide is 20 years of history. We can see over this 20-year period, pretty much the S&P has never been more expensive. Emerging markets are cheap, although they're roughly in the range they've been for much of the last 20 years. Latin America, on the other hand, as you can see, is really, really cheap. It's exceptionally cheap in Brazil. We've tried to show Latin America, just give it sort of the broader region. So you can see Latin America is on 9 times earnings, Brazil is on 6, 7 times earnings. And there are 2 reasons for that. One, Brazil was hopelessly missold to people for much of the period 2005 to 2012. Stories of the wonderful blue sky stories, wonderful, this is the new Brazil. Brazil's going to grow 6% a year, and people extrapolating 1 quarter of data into the next 40 quarters. It is exactly happening actually in parts of the US today. So the Brazil, Latin America in general were missold to people for a long period of time, and we have to take Latin America for what it is, a deeply cyclical asset class that looks to be at the right point of the cycle today. So there's a lack of confidence, as the questioner asked, as well in Latin America, a lack of confidence of locals in their own market, a lack of confidence of foreigners in their own market. That's why there are not many investment trusts investing in Latin America today. But we know what changes that, and that's called the market going up. Market goes up 50%, and suddenly everyone's much more confident about the medium-term outlook. And this has happened time and time again in emerging markets. People don't want to buy at 100. They're very happy to buy at 150. And that would really be my expectation for Latin America. Market goes up 50% from now, and many, many more people will be interested. We're going to see lots of IPOs. But the time to be buying is today, when the market is cheap and when other people lack confidence. Sensible people buy cheap stocks, not expensive ones, as I said at the beginning.
Jeremy asks if the data is from April, if we updated it, have the valuations changed much? Nah,
actually be slightly cheaper. This is a chart that, as it happens, we update twice a year at the end of April, end of October. So sorry that we're doing the presentation on the 22nd of October. It just so happens it's where we are. It wouldn't look very different today. Actually, given the fact that GDP growth has surprised on the upside and we're seeing earnings upgrades in Brazil, which actually is fairly rare, and given that the Mexican market has come off a bit, the multiples today would be even lower than that. So my guess, and I'm speaking without the exact numbers, is that Latin America would be closer to 8 today, and in terms of percentile versus history, would probably be somewhere between 5 and 10 rather than at 11.
I would just like to say, if you're in the audience, we've got 10 minutes or so left, so please do put any questions in the box. We had one about currency movements. Do you hedge against currency movements?
Really important question. Our general view is that in Latin America, as with all emerging markets, the currency and equity market are very heavily correlated. This is not like the UK, where pound goes up and FTSE goes down, or vice versa. In Latin America, as with many other countries in emerging markets, when the currency goes down 10, the market goes down 20, and you lose 28%, do the strange compounding, in a matter of days or minutes sometimes. So we don't hedge. If we think a currency is overvalued or not appropriately valued, we're just not going to be there. And I think I began my comments expressing a degree of caution about Argentina. One of the reasons why we don't have much more money in Argentina is our view that the currency probably has to devalue, and that's probably not a helpful time to be owning investments in that country. we think of ourselves not as investors in real or peso, but as investors in dollars. And we're focused on hard currency returns. And so we don't hedge, because if we don't like a currency, we're just not there.
JW has come back. So the presentation covers the PE of the whole market. What's the average PE of the holding? So I guess, how does your valuation compare to?
Yeah, it's slightly it's roughly the same. I mean, it's slightly cheaper, but not meaningfully different.
And on the gearing, can you tell us how this has changed recently? Why might it change in future? And what is the structure of the debt?
Yeah, so our gearing level is something we put out on a monthly basis. It's fairly high. It hasn't actually moved much. We've been sort of with our foot on the pedal for much of this year, reflecting that we see lots of opportunity in the region, and we can actually borrow money quite cheaply to take that amount of leverage. And that also hasn't changed. That's exactly how we borrow. It's a board decision, but obviously we do it fairly cheaply. And more than covers the investment that we're making. Just in terms of what we're talking about, as I said earlier, we'd love to be overweight almost everything in Latin America, but portfolio has to add up to roughly 100%. In terms of relative preference, we are strongly in favor of Brazil and Mexico. As I said, Mexico sold off, in our view, wrongly post the elections in June. And just as a reminder, in terms of the dividend policy, again, another thing which is very helpful and put in place by the board, we pay out a quarterly dividend equivalent to 1.25% of the NAV. So, and we play that out in May, August, November, and February. So essentially, one can get a 5% dividend yield, for whom that can be interesting for many people. So as was mentioned at the beginning, we're trading at a big discount to our NAV. We invest in a region that is really exciting. It's growing. Its companies are cheap. They're being completely ignored by many people, and we are offering a pretty chunky dividend yield. And that combination of economic importance, of earnings growth, of cheap valuations, and of a significant dividend yield, we think is fairly rare in the world today. And that compares very starkly with the US, as we showed earlier, which has pretty much never been more expensive. So when we're thinking about investing in the world today, we would strongly advocate investors with a medium-term time frame look at Latin America. They look at the economic growth we're seeing in Brazil. We look at the opportunities across the region. We look at how important Mexico is to the United States, and then they look at the region as a whole, offering growth and value and yield. And we think that's a really good place to be. Sorry, Tom.
No, great. I think hopefully we can squeeze in two final questions before we hit the hour mark. You covered the dividend policy of the trust. Could you just tell us a little bit about the dividend culture on the underlying companies? Do Latin American companies offer a high yield like UK stocks?
Yes.
Or is the dividend yield high because of low share prices? Do they do buybacks?
It's also a bit like the UK. But no, many companies have a very historic relationship with their shareholders, and they've had fairly high payouts. That's not just in the materials and the energy sector, it's in the banking sector, it's in lots of places. So payouts are significant, and yes, the dividend yield is slightly flattered because how cheap the markets are, but that's an opportunity today. So it's both aspects.
And clarifying the dividends question is, are you investing only with an eye on total return, or do you try to cover dividends?
We focus on total return, but we do have this dividend yield because we do pay out 1.25% each quarter.
So I've been saving this question for the end because I think it's a great way to conclude, hopefully. But Bryn asks, what are the factors which could turn the tide for Latin American markets?
Well, the first one is the market going up. I think, but more seriously, I think domestic investors in Brazil have an enormous amount of money. They're broadly out of the market given where rates are. I think rates coming down would be very significant. I think inflation coming down, which is something we've been forecasting all year, would be important. And I think a degree of fiscal prudence, increased fiscal prudence in Brazil would be very helpful for the region. And finally, I would suggest that some of the announcements that the new Mexican administration are going to make over the next few weeks and months will be supportive of inward investment into that country.
Fantastic. Well, thanks very much, Sam, for your presentation and for answering all those questions. And thank you very much for everyone in the audience who has participated. Hopefully that was useful. I think that's the concluding event in our webinar series looking around the world. Thanks once again, Sam. And yeah, hopefully speak to you next time.
Thank you. And thank you for the questions. Much more interesting that way. And have a wonderful afternoon.
Have a great afternoon. Bye, everyone.